Let's get started. So we are going to start with Tesla. We talked about this a little bit over the last couple of weeks. Very, very interesting here. We have gotten some sell-off. Our levels were perfectly curated from the start. As you guys know, we were looking at this 203 as being kind of an inflection point between bulls and bears. And in order for the bulls to take over and then hit the top of this little wedge here, we needed to see that price reverting and not breaking down, either breaking up right here or holding on support right here, and neither of which happened. So as a result, we saw more downside. Our first downside target was 183. That has been hit. We are currently at about 163. I put my buys in today at 161 and change, 162 and change, to initiate the beginning of a long position, which will grow over time. I am expecting, to be very frank with you all, I am still expecting more downside to trend line, because again, remember, this is long-term trend pivot, right? So this is where resistance became support and became our point of breakout back in, let me take a look at what the date is. Back in April of 2020 is when that happened. And as a result, gives us pretty good data to work off of, because it was also our bottom in January of 2023, which is the lowest point Tesla's seen in a few years. So we can be quite confident in this trend line to hold and give us the data and the trust that we need to initiate this long position starting here. The reason I'm starting here and not waiting for 143 is quite simple, and that's because right now there's the potential for basically where we are trading right about now, 160s call it. There's potential for this previous range to kick in, which ends up being right where we really broke out back in October of 2020. If that range kicks and this holds, then this is going to be our pivot point. But as I said very clearly in that the trade alert I put in the Discord, please be very mindful of the way in which I'm trading this and take that into consideration with everything you do, because at the end of the day, I am going to buy this down. Hold on one second. I'm going to be buying this down to the 140s, which could put us as low as, I'd say, 142, 140, maybe even 139. If we dip hard here, then we could see as low as 139. And the goal here, this is a very simple trade. The goal here being we reclaim trend support, that trend pivots, turns around. And after turning around, we first touch 182 and then 203, and we have a perfect bottom dollar position for the break into this range to hopefully reclaim 265 plus. This is a position I am putting into my long-term portfolio. It is something I intend to hold. My current cost basis on Tesla, I believe, is like 94, 95 bucks. So I'm bringing up my average a little bit here, but it's not something material that I'm particularly concerned about. So take that into account, obviously. So we need to be, again, very mindful though, because guys, the truth is like the way I'm trading this might be different than the way you are. So I want you to know that and understand that, because if you're only able to buy one or two shares, this might not be the time to do it. If that's the case, what I would do if I was buying one or two shares is I would wait to determine whether or not we get reversal here, and then I would buy the way back up rather than waiting and buying down. And inevitably, if my average ends up being around 150 or so on this position, this core position, not the whole long-term position, but this chunk that I'm adding now, I am going to probably kill it if we can't hold trend line here, because then we are in for a little bit of a rude awakening for Tesla stock in particular. So it's something to be very cautious of, be very mindful of, and be very considerate of, because at the end of the day, guys, it is a scary thing to be deep into a position if it is not going your way. And that may happen. But again, I would say I have decent degree of confidence. I trust the ranges we've outlined. I know this is a lot of business on this chart. These are a lot of lines. But just a quick walkthrough before we get into some day trade opportunities and try to continue our week of 17 consecutive spreads in a row of profit, even after Microsoft got so dicey. We want to go through these Tesla levels and then we'll get there. So remember, we mapped out how far does Tesla move and in what period of time? And what we found was we saw in an average period of like 40, 50 days, we saw 40% move over 35 days. Right here, we see a 30% move over 119 days. Right here, we saw a 50% move over 77 days. Right here, a 45% move over 55 days. And then finally, 29% move over 57 days. So basically, what that does for us is tell us that, okay, at a minimum of 50 days, we're seeing about a 30% move in the price of the stock. That is pretty damn optimistic, if you ask me. Now, we get the same volatility to the downside. So that's something to always consider because just as quickly as it may move to the upside, it may move to the downside. So I think the important thing here, like I said, is to take all that into account and understand exactly what makes sense for you so that way you can take this trade appropriately if it fits your trading plan and your dynamic. So again, high degree of optimism. I think we're getting out of hand here with this downside. It just isn't making sense given their recent sales numbers, their new pricing strategy. To me, this just isn't adding up. So I'm looking at this as I don't know, I wouldn't call it overcorrection, but I'm looking at this as something a little. Let's see what Stocks Buddy says here. Oh, Stocks Buddy's already on. Weekly, we're still bearish. The monthly, still very bearish. Until we see 250. Let's see. In the 1 hour, have we turned over yet? No, still bearish. So keep that in mind. We're pushing up against the top of what Stocks Buddy considers bearish. So keep that in mind. If you don't have the indicator, just stocksbuddy.com/tradingview. Go get it. I'll put the link. It's the best indicator you'll ever use in your life. Gives you buy, sell, bull, bear, gives you entry, take profit, automatically calculates your stop loss, and my favorite like noob feature, if you don't know how to do technical analysis, it draws the trend lines for you. So all you have to do is basically trace them. It's a feat of excellence. I fought it, but now I support it. So yeah, here's a little bit of a closer illustration of where our support lies for Tesla in the long term. And you can see it's hovering right around 130, 140. So there's still definitely more downside. I do like the buying pressure that we're seeing swell up here on the hourly over the past, what was that? Yep, that's all today. So over the past day, I do think we are starting to develop a firmer bit of support here, maybe 160. And remember, that was the past range. So that's important. It's important to know that each range, you need to know it because it's where buyers and sellers, remember, this is just a simple game of tug of war, right? Buyers are selling, buyers are pulling, sellers are pulling, and then you just watch the flag in the middle, right? But what you want to find as a trader, investor, what have you, you want to know what are those pivot points? Like, where do you draw the line in the middle of where they're going to pull the rope? Because then when they pull it below, okay, we're going bearish, and you can take that trade and you can make your money. If they pull it above, okay, we're probably turning bullish. I could take that trade and make me some money. Turn the slide on. Goal here is just set you up for the utmost success. Oh, that looks way better. I don't look like a zombie anymore. That's good stuff. So, okay, I am ready to go. Bull, I did turn you down on Discord. I turned you all the way down. Boom, doom, 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 doom. Boom, boom. Okay. So that's our little bit of Tesla. Let's take a quick peek throughout the markets and see what else is going on and see if we have some day trade opportunity. And lo and behold, it looks as if we do. So interesting on the SPY. Okay, we're hitting the bottom of our trend channel here on the SPY. We did break below a little bit. So this is pretty critical. This is important, guys. Basically, I'm gonna add Senor here. Let me get this into a better view. Well,
There we go.
so look at this, man. Look what we have here. This is interesting. So SPY coming to bottom of channel, which is interesting. What we're about to experience is about to be a beautiful swing entry or a whole lot of pain. Don't you think?
Yeah, I've been looking at that trend line as well. Also on the daily chart, the 20 MA pretty, accurate lately. Lines up with that. So break below that, definitely going to see much lower 500s for sure.
Well, we talked about it on the Monday stream. I talked about it that this area of confluence right here, we're looking at 507. That's a pretty critical area. And when we're trading right up here, we talked about that. If we break below 515, so again, once again, for those of you that follow that stream, we talked about the 507 and 509 puts. If we broke below 515.75, those would have paid multiple hundreds of percent today. Multiple hundreds. I don't know. Thank you. I don't know where Porter is to give me the exact stats, but nevertheless,
There we go.
we have bottomed in the range, which is very interesting because like we either experience what we did right here, where we came to bottom, another point of confluence, basically where this trend line intersects with our horizontal range we outlined, and then we boomed. We either see that again and we push north of 515, or could this be the opportunity for the Bears to take some here, go sell side, and take us back to the bottom 494? I think would be my next target. If you look, we were very sparse through here. There's a lot of gap going on
Quench,
all throughout this.
that would be a reminder of 2022, basically.
Oh God, that was not fun.
Well, we made a lot of money shorting
I
it.
know. It's just too much anxiety, man. It was just too much anxiety.
Gotta have a tasty account.
Ugh.
No
So
other brokers had short shares available.
yeah, I know. So I'm looking here at a few spread opportunities. I'm liking a lot is I'm liking the buy. So let's get you in there, start doing your master calculations. But I would say if we go minimum risk but maximum return, or not maximum return, medium risk, medium to low risk, medium return. I like the buy 505, sell 507 for the 22nd of March.
March 22nd. Let's take a look. I mean, that's
Dude,
did you see
how I got nut punched today? So I didn't close all of these Microsofts.
You were up pretty good on those.
Yeah, I didn't close them. They were up 60% yesterday. They were up 60%. I hit my 250 for the week, which would have made this 17 weeks in a row. So it hit, but I just didn't. I don't know what I updated in the Discord, but I just didn't close it. And then today they just boomed, which doesn't make sense because they're out of the money. So, but it's red today, so it is what it is. But they're out of the money, so the theta should work in my favor. And Microsoft.
I mean, with the spreads, a lot of people's that trade the spreads, their price targets are like 50% of the premium is usually a good rule of thumb there. Especially if you can close it out early before expiration, then that kind of makes up on the calendar year not getting that other 50% or whatever. But yeah, we can definitely look at the. So you're thinking March 22nd, which is a week from today, and you want to sell the 507. Okay,
I want to buy buying the 505, selling the 507. Why did it put me so far up the chain? Selling the 507. Total credit would be 58.
Okay, let's take a look there. So selling the 507 put, and this is going to be a put spread, credit spread, so bullish. So we could just kind of go off the bid prices here. So the 507 put right now, the market's still open, so it's changing a little bit, but you'll get a $245 credit for that. Now, when you buy the 505, that's going to cost you a 186 debit. So yeah, actually, total credit received is almost 0.60 quench, and on a $2 spread, return on allocation simply 60 divided by the 200 So that's a 30% return on allocation right there. Now, keep in mind, the credit we're receiving is almost 0.60. So if we take $2 wide spread, which is $200, and then minus out the $60 credit we received, our max risk is actually $140. So that's the most we can ever lose on the trade. And if we're collecting a $60 credit divided by our max risk, this is actually a 42.8% return on max risk, which I think is pretty solid. And the goal here is SPY to stay above 507 by next Friday. You'd be able to realize 100% of that credit.
Yeah, or a
of course,
strong upside
yeah.
move Monday through.
Yes, listen, a strong upside move. We could have 95% of this credit on the table tomorrow, or Monday. Today's Friday. Yeah, I'm hearing the echo as well. I'm not sure what that is.
Oh wait, hold on. Maybe I need to turn
down.
your turn.
Yeah, you got to turn me down.
I think I have
Discord.
the solution. Let me pop this. Let me pop this in there. Let me get this going. Oh, unless Discord shares your whole audio, that's probably
what's going on. Yeah, but I'm still.
Oh, see if you mute yourself. Ben, say something.
Hello.
Can you guys still hear Ben?
Testing 1, 2, 3.
Okay, good.
Yeah.
I muted you, so it's just sharing my whole audio, so we could hear you now. We're good to go. No more echo.
Yeah.
And
that happens when you're stream sharing on Discord. You click that option that says audio. You're gonna get the echo. Yeah, it's still gonna echo. So. Anyways, I'm gonna mute myself.
No, I fixed it.
Nah, it's still there, brother. We'll figure that out later.
Yeah, I don't know. Oh, maybe it's me. Can everybody on Discord still hear me? See or no? Can you hear me? I'm guessing that's a no.
Yeah, it's all good, man. We'll put this together, and maybe every Friday I'll come here with you and get on here with you. We'll figure out these tech issues behind the scenes, and we'll be ready to rock and roll by next Friday.
Dude, because you realize that if we can craft another spread this week, that will be, even though I shit the bed on that Microsoft, this will be 17 weeks in a row. We've effectively made at least $250, at least, with a spread trade every week for 17 weeks. So let's do that math here. So 17 times 250 minimum. So we've netted about 4,250 over 17 weeks. And if there's 4 weeks in a month, that basically puts us in 4 months. So we're basically making 1,000 a month with passive option spreads. With, I believe most of these require less than $500 in capital in the account, correct? I can't hear you anymore. He's gone. So I guess that's it. Goodbye, Benjamin. I love you. I'll never forget you. I'll never forget you. So yeah, so that's the spread. I do like it. I still have this fucking buying power issue because I didn't close that spread. So I need to fix that. But I like this one. I'm gonna put this one out there. I'll post this for you guys. So we're gonna buy to open the 505, and we will sell to open the 507 on the SPY. And I'll go through the chart and why this to me makes sense right now. A little bit of calculated risk here. These are both for March 22nd, so that gives us 1 week. So all we need is a strong day on the SPY above 507 to really see these diminish in value quickly. The estimated credit is $50. Bull, would you do me a favor? Will you pop that in the spreads channel for me? Pop it in there so they get it too, because I know we had to do a certain amount of tags for that. But yeah, guys, so this should be, I'm hoping this will be, fingers crossed. We've got 17 weeks in a row of at least $250 profit from these spreads. I'm hoping that this will make this 18 weeks and counting. We have been bleeding Microsoft dry overall. Oops, Stocks Buddy Daily just went bearish. And it's pretty good most of the time. So here's what we're thinking on this spread, right? So again, this is a strong area of confluence. We've outlined our horizontal range, both the top and the bottom, which as long as price is trading in between, we know the top, we know the bottom, that you can trade from the bottom to the top to bottom, over and over and over. This is a wash, rinse, repeat trade, easy peasy. We know this to be true, right? We've been doing this for years now. Remember, we were buying March 470 calls back in October. So when SPY was trading at 427, and I was very public about this and received a lot of flack on both Twitter, StockTwits, everywhere else, we were buying these dips right here, October. We were loading up the 470 calls for March of this year, which paid at about 400%. So that was a hell of a trade. I mean, it was easy to see that was bottom and that we were going to climb. I didn't think we'd climb this fast, but we did. So those were phenomenal. I think right now, I think that there's definitely some fear breathing in the market at the current moment, but I don't think that it's so much so that we are going to see a steep decline over the next week. I mean, it's definitely possible because, again, point of confluence, we expected price to come back down and meet us right here, where longer-term trend line dating back to February, so monthly trend line, intersects with our horizontal range, which was 507.90, and our monthly trend line right there dating back to February. We knew price was going to revert back to this area. So again, we thought it would be earlier in the week, which it tried, failed, and then eventually came down. So we knew what we were getting into. We looked to the chart to see this specific example, which I think kind of paints the picture for us here, right? So what we have right here is the exact same move. We pushed up, new high, came down, found that point of confluence, again, where this monthly trend line intersects with our horizontal range. It's like a magnet. That's the important thing to know when you're looking at a chart. It's like that point is like a magnet. The price is going to be attracted to that point on the chart, that price and time value. And so that was an opportune place to load up on swing calls, right? That ran from 494 to 516. So remember, if you guys remember from the Monday stream, every Monday, 5 p.m. Eastern, don't miss it, on our YouTube channel and our Twitter, we talked about taking those 500 calls and those 505 calls, which again paid over 100%. I mean, how many times do I have to do this for people to pay attention? These charts are predictable to a degree. No one can ever be right 100% of the time, but what we can do is take the past information. We can use it to our advantage by saying, okay, these are the most probable outcomes. Let's trade those rather than, I think it's going to go up tomorrow, and I think it's going to go up by this much. This is why like 0 DTE options and 2-day expiry options are so dangerous, because we can predict price to an extent, right? Or anticipate price to an extent, correction, within a time frame. It's kind of like you can't predict the future to the minute, but you can assume reasonably so that price will be around this price around this time, meaning we can estimate that, okay, SPY turns around from this being relative bottom. We can reasonably assume, if that happens, that in 2 weeks' time, we're going to see SPY north of 515 again, if this turns around here, right? So we're going to see at minimum $5 move in at least 2 weeks' time. That could happen in 1 day. It could happen in 1 hour. But the point is, we're positioned well to maximize profit if we go into it with that line of thinking and that perspective, because we are taking the right trade in the right direction, following the trend, while also managing risk effectively. We've talked about this. Many of you have in the Discord, guys. Like, managing risk is so much more than just like having a stop loss and like not buying put your whole portfolio into tech. It's about so much more than that. There are so many ways to manage risk, which is why, for those of you that are in the coaching program, you understand it. It's broken down into 4 sections. Like we help you become a master of swing trading. Then you become a master of day trading. Then you become a master of passive options. Then you become a master of technical analysis on the whole, right? The idea is passive options can be a hedge and a profit generating tool. Day trading can be a hedge and a profit generating tool. You use these 4 methods. That's all I think anyone needs, is 4 methods. Use these 4 methods holistically. You are a complete trader, a complete investor that will never get beat to death by 1 or 2 mistakes, which is the only way people lose at this game. They get beat to death on 1 or 2 mistakes, and then that's it. If you're out of the game, you're out of the game. Part of the deal here, you guys, for those of you that are just into this and you want to do this for the rest of your life, you want to quit your job and do this, whatever it is, until you understand that fundamental truth, that this is a holistic science, if you will. And you have to understand these 4 quadrants, which is very simple, just 4 things. If you understand those 4 quadrants, you can cover your ass from every direction. You can take advantage of every opportunity to a degree, and you can master a few simple techniques that make you the master of your money. That's the point here. If you try to have a watch list of 800 stocks, like, you're just probably not going to make it. I have learned the SPY chart in and out. I obsess upon it. And to be honest with you, like, just from the one live stream, again, Mondays at 5 p.m. Eastern, this 2 trade ideas. Remember, we always map out what's the bullish philosophy and what's the bearish philosophy. And then I give you the exact options contract I'm going to trade when it hits those parameters. There have been 2 or 3 100% plus swings given those 2 options contracts if you just followed that little methodology, which requires you to only understand how to draw 2 horizontal lines. That's it. So for those that are following that bull put spread, what you can alternatively do is, for example, you can in effect hedge that by also buying like the 506 put just out of the money, but 2 days out, right? Very cheap, very, very cheap. It'll expire worthless, right? It'll expire worthless if this happens. But I mean, that's not the best way to hedge, but it's a way to hedge, right? Because right now, again, it's Friday, it's 2:33. I don't really like if we traded 0 DTEs right now, we could make some money. Trading 3 days out won't make as much. We might make some. I know last week we did make some good money trading those 3 days out. I think, did those run 100%? I think they ran like 98%, right? Right. Guys, come on. You were there. I'm pretty sure. it was. But anyway, I'm not going to wait. So that's what we think for the SPY right now. I think right now we're just trying to trade against 510. Stocks Buddy, the indicator, has outlined that as the dynamic stop loss, which would basically mean that if it breaks above 510 on the hourly chart, the trend has then reversed to bullish, and then it will recalculate the stop loss for the bullish trend. And it switches every time the trend changes. It gives you your stop loss or your break point where the trend has changed and you need to really reassess your position. So, for example, if you were in calls right now and you see it getting rejected at 510.57, there should be some concern in your voice. So for those of you that missed it with Tesla, to jump back to that real quick, bearish on the hourly, but I do like it. I'm starting to like it here, right? If we get a nice reversal here, buyers are starting to pick up. We had 160 as our bottom we were watching. That coincides perfectly with both our breakout points to the downside here, our breakout point to the upside here, and then also the support and mid-range that we saw right here. Once again, this is tug of war. You want to find the middle where the bulls and the bears are pulling the rope back and forth. That's where you want to be, because then you're in the perfect position to take both the bearish trade and the bullish trade, and you will have the minimum amount of risk because you're standing right at ground zero. So we want to use this level as kind of our next, that's our best possible anchor we can place in time and price to understand where Tesla might react and go in the direction that we think it's going to go, which is to the upside. Again, this is a longer term core position. So I already have my long-term position at a cost basis of like $90 a share. I'm just adding to that, but this specific position, which I'm looking to buy maybe 50 shares total, put about, what is that? Like, I don't know, 7, 8 grand. I don't know. I can't math right now. Whatever that amount is. This position, though, I will probably place a stop loss on. I'm going to buy down. So this is our next kind of worst case scenario for this one, which I don't even call it the worst case scenario. We have a long-term trend support here. Let me zoom this out so you guys can fully capture this. This is long-term trend support, right? So we validated this trend support the last time we sold off on Tesla, December 27th. We validated this long-term trend support. What I like to do, my own personal strategy, take it for what it's worth. Everyone does technical analysis a million different ways. I don't think there's that many ways to do it. So this is not something really inventive or new, but it's worked for me for years. I like to find a pivot point from a consolidated chart like we have here. Tesla was trading from 23 to like 17 for almost 2 years, right? So we know that this resistance right here is pretty significant for it to break, and it's got one touch there, confirmation there, and then breakout, boom, and then it ran. So we know that this ascending support is a pivotal price point for Tesla because look, once it broke in April 2020, it took off. So we know that we can extend this out. And then if we get confirmation on this, which we did right here, we can say, okay, looks like this is a pivotal, this is that middle of the tug of war game, right, that we talked about. This is a pivotal price point that we need to keep our eye on because it's where Tesla becomes volatile and reactive, if that makes sense. So what we're expecting or anticipating here is that Tesla may continue to sell off until it hits 140, 145, and it should become, in theory, reactive here. Once again, if it doesn't, continues to sell off, then that's a problem, and we're going to revisit $100 a share probably. So keep that in mind when looking at this as a long-term equity trade. I like it, but I'm also willing to buy down. I bought about a third of my position, the total size that I'm going to buy, and I'm willing to let it go. So for example, if it turns around here and starts ripping, I'm not going to add to that position. I'm just going to take the 30% of the position I have and roll with it. If it sells off to 140, I will buy down and I will build that position into ideally a 153, 154 cost basis. And then I will ride that up or I will kill it on the way down, either or. So, yes, D's nuts. What you think about coin here? Coin D's nuts. So, what we did on coin, our trade on coin was we were buying at 75. That was our pivot point. At least if you're in the Discord, I don't know if you are. If you're not joined, I'd love to have you in there. We were buying coin at 75 bucks a share. It's currently up to 241. We doubled our money, doubled our fun. On options, we took a literal 1,000% gain on this. It was a phenomenal trade. Easy to see. If you could look at this coin chart, I mean, this was like so simple to see, in my opinion. I love finding me a good range. Again, we talk about those pivot points, right? Resistance, 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 breakout, resistance, breakout, resistance, resistance, all the way through until breakout again, right? So this one line, this price, 72 to 74 bucks, was resistance for all that time, and then it became the breakout point, right? Right here. And then we come down. Now that we're trading above it, all of a sudden this becomes support. That tells me this is a pretty pivotal price point. And as the trend reverses, this is a pretty good place to start building a position. This is a lot of times how institutions will do it. I mean, they manipulate the price for sure to maintain a lower cost basis, but I like to trade this way. It's always worked for me. Again, resistance all the way through until it becomes the point of breakout, and then it comes back down. Now it's our point of support. And as you can see, it never came back down past that. It came back down as low as like 113, but that was it. So we were buying at 75. I'm still holding a chunk of that. It's trading up almost 300% from where we bought it. I think right here with crypto on its run, I would like use like something like Stocks Buddy. Again, it automatically calculates the stop loss. You're on the weekly chart here. So on a weekly basis of continued bull trend, Stocks Buddy calculates 168 being your dynamic stop loss. So it automatically adjusts itself based on how the price trades. So basically, I would agree with that because as you look right here, you can also see a nice bit of confluence there. Support, support, breakthrough, support, breakthrough, and then resistance, resistance, and then support. So you have that confirmation and confluence, confirmation, whatever you want to call it. Confluence just means like points that intersect and kind of validate your data. Same thing as confluence is the place at which they meet. Confirmation is the process of them validating one another, I guess. So to be clear on that. But I do like it. If it can stay north of 222, I think there is still some strong bullish upside. The case is there for Coinbase as a key player in the crypto space for US adoption. So I do think they're ahead of the game. I mean, there's always a first mover advantage with everything, and I think they've definitely nailed it in many ways, as long as like they don't get hacked or the platform doesn't go down and start burning in flames. Wait, to CAC, you're telling me who alerted Coinbase at $35? Don't tell me it was me. I would love it if it was me. Was that sounds like a Lee special. So I guess we were buying that at 35. I thought it was 75. I'm gonna have to do a quick search there in the Discord. I'm gonna have to find that because that's good information to know. I also want to make sure that I'm backing up what I'm saying here. I don't expect anyone to just believe me. I'd much rather prove it personally. Yeah, I don't know. Someone could find that. That would be interesting. I'd love to know. I don't know. Maybe that was in rest and retire. Short-term movement because of that call. I mean, so he's what these nuts is asking here is, he's long equity 51, great entry, dude. You nailed it. That's fantastic. You're asking, what about the short-term movement because of that call? I mean, again, using indicators, the right tools makes it easy like stocks, but he makes this cake. But so far on the hourly, you've got bullish signal given 221, automatic stop loss calculated 234. So I'd say above 234, you should be good. What's the expiration date on that? Because you want to understand exactly how price is interacting. You want to know how much the time decay is going to kill you. There's a bunch of factors if you're trading options you want to definitely understand. And also, I would say having a solid position if you have more than 100 shares, my take would be what I do is I buy 100 shares so that I can sell covered calls against it rather than trading that upside. April 5th, what's the strike? So what is the price you're expecting it to reach? Because for those of you that just need a quick refresher, as we always talk about, options function on a bell curve, right? Your goal with options trading is for your strike to be right here. You want to hit your strike at maximum time value and be in the money, right? So this axis right here is your time, right? And this axis here is your price. So anytime you're trading options, one thing to always consider, if your expectation is, so we'll use Mr. D's nuts as the example. So what's April expiration? Early April 5th. Okay, so you got the 235 strike. So you're expecting you're in the money. Did you buy in the money? Oh, 260 strike. Wait, did you buy it in the money? Because that's a different story. You don't have much upside. You don't have much appreciation potential if you're buying in the money. Personally, I wouldn't do that because there's really you're not getting the value of increasing delta and amongst the other factors of escalating into the money. Yeah. So, I mean, personally, if you're green, that's a position I would kill immediately because you don't want to have that. I wouldn't want to have that much risk on the table, given I'm already extremely green on the position, and there's much better options possibilities than that. So let me just break this down because I think this will make a lot of sense, especially for those that are new in options or just haven't had the experience. Time is your X, price is your Y. If my expectation was for Coinbase, right? My expectation was for Coinbase to get to 235 by April 5th. I would want to be buying those calls much sooner. I guess we'll have to use a future looking example. So let's look at in the past, right? We've seen Coinbase go from 248 to 360, right? Let's map out. We're going to map this out. You're going to love this because I think this is the best way I've ever heard it explained. Date and price. So let's look. So when it was trading right at this level, it took 27 days for Coinbase to run 50% plus, right? So Coinbase moved $127 a share in 27 days. So let's round that up to 30 days, right? Let's say it moved $100, $130 in 30 days. Great. So that means your best case scenario, looking at where we're trading right now from this same range, right? Your best case scenario is that over 30 days, it'll move $130 in price, right? And again, there's only really one instance to back that up that I would use. So like, this is not a trade personally I would take, but to break it down for the sake of the lesson, right? So again, options function on a bell curve. Important to know that. I don't know why it messes up your drawings when you do this. So let's get rid of that stuff and we'll redraw it. Options function on a bell curve. That means that time is always working against you. The only thing you can control is how much time you give yourself, which is important. We must accept the things we cannot change, have the courage to change the things we can, right? So we can control how much time we give ourselves to a degree. So options function on a bell curve. Again, you have price as your y-axis and you have time as your x-axis. So if I wanted to see Coinbase move $130 a share, I know that it's possible for that to happen in 30 days. If I had more data to justify it, I would say, okay, look, 4 different times Coinbase has moved $100 in 30 days. So if I'm buying right now with the expectation that it's going to move that $100, because again, you don't want to be in the money when you hit expiration, because that contract is going to lose significant value as a result of the theta, right? Time decay is basically just like, imagine you're running a race with sand in your hands, right? It would require the most careful hands you could ever imagine having to not let that sand slip out. But let's imagine that you're not going to be perfect, right? So little bits of sand with every bit of movement are slipping out of your hand. You start with 10 ounces of sand. You're going to finish the race with maybe 3 ounces, right? That's what time decay is. It's that sand slipping through your fingers, except that sand is the value of the option you bought. So basically, it's the trust that the market has in the bet you're making. So it's the market saying, I don't think it's going to move. I don't think it's going to run $100 in 30 days. I'm not buying. I'm not in it. I'm not into it. So what you need to do is figure out exactly how much it moves and how long the time and how much it moves in a period of time. So if it's $100 in 30 days and we're currently trading at 241, we're saying that we think Coinbase will reach $341 a share in 100 days. So in theory, you could buy the 330 call and be in the money and maximize profit if it does what you think it's going to do. But here's the key, and I'll put this up to a quiz. If that's the case, what expiration should I buy? If I'm buying the 330 calls, I'm expecting it to move $100, and I know that it typically moves that in 100 days. How much time should I give myself on that contract? What expiration should I choose? If I'm expecting Coinbase to move $100 in 30 days, potentially, what expiration would I buy on that 330 strike? Quiz time. So we've got one answer. The stick man says a year or 2. Anybody else want to volunteer their answer? Page 307 says 60 days. Cool says 3 months. Charlie says 30 days. So again, in 30 days, we expect a potential $100 move to the upside, right? Exactly. Definitely not a few weeks. Not really even a few months. Because again, if you're maximizing your profit here and minimizing your risk, you want theta to not destroy you, right? You want to protect against theta. So again, as you get closer to expiration, you lose more value every second. It's like running that race with the sand. As you get towards the last couple miles, they force you to open your fingers, right? So more sand's just pouring out. So again, if it's 30 days that you expect it to hit, you'd want to give yourself, I would say at minimum 90 days. And I'd say that's still riskier than what you have to do. So at minimum 90 days out, because if you're going to hit it by 30 days, that means you're giving yourself 90 days to get there. That means by day 45, you need it to hit. And again, if it's moving $100 every 30 days, then that means you'd be in good standing because you'd actually be closer to here and here, which means less theta decay. You're already in the money. And guess what? If you're already in the money, you can hold that thing. So what I did, I had those, for those of you that have followed my accounts, I bought those NVIDIA $250 calls when it was trading at like $150 a share, right? I held those even when it was trading at like $400 or $500 a share because I bought them, I think, 2 years out. Because I was so deep in the money, those contracts compounded in value so quickly, like to the point where they were thousands of dollars a day, right? To max profit, I ended up at one point, I was up 2,431%, I believe, on those contracts. It basically 100 grand. I ended up exercising one of them to keep the 100 shares because I do want the 100 shares at $250 cost basis. And I can sell premium, I could sell covered calls against it now and just make passive income while I hold shares of a company I want to hold. So win, win, win. But again, to the Coinbase example, that's exactly why you don't want to buy a month out, because you're expecting it to hit 30 days in. Like if you're only giving yourself 30 days total, then that means you need it to hit in about 10 to 15 days, which we know based on the chart, it's unlikely that it'll move more than $100 in 30 days. Again, taking this information in, we can never make, perfect predictions, but what we can do is we can use that past data to justify future decisions, to where we're going into this with a plan, right? Like that's what we preach for those of you in the Discord, right? Like we preach that, we teach that because that's what we do. So did you win anything? Cools? What did you guess? 3 months. I liked Duck. Well, where's Duck? Give the man something. He won something. We'll figure out something. My guy. All right, we'll get you taken care of, my man. Don't you worry. So I hope that helped. D's Nuts, Mr. D's Nuts, did that help with the Coinbase options debacle? I really hope it did, man. I tried to break that down. Options are so complicated and it's so convoluted, but I want to make sure that it's making sense to you guys. Let's go back to Tesla because there's a bull put spread I was looking at. Tesla is interesting, but a little dicey. So look, Tesla goes green today, guys. We're in a good position, adding that equity at 161 and change. That could be good. I like this little doji forming here. Those can, not always, but can indicate reversal, which is a good sign. Right on, my man. These nuts. Come join us in the Discord, man. Go through the coaching program. Actually learn how to do this the right way. Put your money to work. Like the argument I always make is like, look, if you put $1,000 into an options trade, right? How long did you have to work to make that $1,000? Let's say you have a great job and you're making $100 an hour. If you put 10 hours into making that money and you put that money at risk because of a 2-minute decision, what'd you expect to happen? You know what I'm saying? It's not to kick anybody in the nuts, but it's what I've done, and it's the times I've punched myself in the face. The truth is, I usually put a couple hours at minimum into a trade if I'm going to put more than a couple $100 into it, because I want my money to be safe, sound, and happy. And I want it to make money babies. I want my money to go out into the world, meet other money friends, and basically go on Money Tinder and meet some handsome money gentlemen or money women and make more money babies and bring them home to me. Bring me money grandchildren. But they can't do that if they're not well taken care of, just like a child. Must be well fed, well nurtured, well guided. Someone asked thoughts on Adobe-san. Let's take a quick look at Adobe. Selling off after earnings. This is kind of the AI expectations thing that really is just kind of a nightmare, man. I mean, it's setting up a number of companies for, I think, absolute failure. I mean, I was just reading someone posted something interesting on Twitter today about this, really diving into how these AI valuations and fluctuations as a result of the whole AI narrative can kill companies that actually posted decent earnings. Let's look at that. So let's go to the nasdingle.com. Let's look at Adobe's earnings and their future expectations for earnings. Dude, whoever's running NASDAQ, if you're listening, whoever's running your website, fire them, because this website takes forever to load. Like this website takes forever to load. It's ridiculous. You need to do something about it because it's really making my life difficult. All right, Adobe. Like I couldn't even pull up PayPal earnings. Like come on. How's a boy going to look at PayPal earnings? Which, quick aside here, guys. How about this? We absolutely nailed it so far. I mean, The PayPal trade that we put out, we did the 100 call for 2025. We have more than, I think we did December, so we have almost 2 years of expiration for this to hit $100. Boom, we're already up 30%. I expect this one to be a multi-bagger, meaning I expect a couple 100% return should PayPal turn around. Let's go back to the NASDAQ. So we got Adobe and earnings announcements. Oh, well, I guess they didn't beat. So that's their problem there. They're going to be pretty consistent in terms of earning growth. So, like, for instance, the Adobe trade now is you're trading the first quarter of 2025 as long as guidance gave you the confidence to say, hey, we're going to beat the shit out of the next two earnings. They've got some revisions to the upside. Surprise was not great there. But again, trading ones like these, like, you guys know my philosophy, and it's how I've basically crafted these 2, 3, 400% option swings that were safe and truly quality plays, not like overnight earning swings. Guys, I'm talking, we're premeditated. I want those trades dialed in 6, 7 months in advance before we ever get into the trade. Because at the end of the day, when you trade earnings, like, you are taking a risk. The goal is to trade with as few variables as possible, but it's inevitable at times that you're going to have to take some risk. Oh, there he is. I'm going to bring my man in here. The man of the hour, Mr. Shai Balor, Mr. Cloud Tech Growth. What you thinking looking at Adobe here? How do you feel about that earnings readout?
What's up, everyone? Can you hear me okay, Austin?
Yep, I hear you loud and clear.
What's up? What's up? Adobe, wow, what a price action after their earnings. I know a lot of you are probably like scratching your heads, or like a lot of people on Finto I'm noticing scratching their heads and like, why is it down 14% on it looked like a beat, slight miss on guide? It's because there's a lot of things that are happening that's beyond like the text that you're seeing or the numbers. What I mean by that is this is probably the first quarter potentially that's, or no, it's the second quarter since like really the LLMs have made a pretty big segue into video. And even mentioned this to the subs that Adobe could probably might be able to get disrupted in a year or two. Like, it's wild to say because they have such a massive um, moat in the past decade. And if you look at their fundamentals, it's absolutely juicy numbers, like 40% free cash flow margin. Like, that's elite. Like, I almost want to say unicorn status, where if my favorite metric of quantifying growth tech is the Rule of 40 score, what is that Rule of 40 score? It's combining the revenue growth plus the free cash flow margin. And if you have a 40 or higher, you're part of the elite status, and you absolutely always deserve a premium valuation on your multiple if you score 40 or higher. So if Adobe has 41% free cash flow margins, they don't even have to grow their top line at all for them to qualify. The reason it's dipping so much is their moats might be fading now because these LLMs are able to create these like sophisticated software using video and editing video for Photoshops that there's a potential headwind risk now down the line that Adobe's like moat might be slowly fading away if they don't somehow pivot to get on top of this. I forgot what the new application is called on ChatGPT, but they created this. I'm sure everyone saw this video where they put some inputs into this LLM and created this like high resolution 4K video that looked so professional, but took minutes of creating. That's a similar adjacent reason why Adobe might be getting disrupted. And it's something that's like not being seen in the numbers. It's definitely the 4D vision of like, wow, maybe. And it could be like forward anxiety is getting pushed up right now that isn't deserved to be. And that could be absolutely it. But again, it is something to be alarmed at, especially when them like not meeting their guide and guiding lower on top of the noise about like, will this be disrupted due to LLMs? Like, another aspect is QuickBooks pricing is super expensive for SMB, so Intuit might get disrupted as well as LLMs. Another one is Salesforce. This could get disrupted by LLMs. Like there's like a lot of these massive moats who are free cash flow machines. They haven't really innovated that much in the most recent years because they haven't really had to. They have such an insane moat that's high barrier of entry for competition with, and they're
Yeah,
printing
I feel like
cash.
it's hard for them to innovate it with an enterprise model anyway,
Mm-hmm.
because it
Absolutely.
requires so much change. You know what I'm saying? Like it's so like that's a twofold difficulty of both system process tech, but also onboarding, education, client usefulness. You know what I mean?
No, you absolutely nailed it. And them trying to acquire Figma and failing, they almost let a little glimpse into like they're not really innovating organically. They have to make this flashy purchase. That didn't come through. And now investors are like, what are you gonna do? Like you're growing, yes, you have 40% free cash margins. You've been like that. You're growing to low teens, guiding to 10% growth. That doesn't really do it anymore if you're going to be not innovating organically. Like we've all saw Palo Alto, ticker PANW. Like they have not been innovating in the cybersecurity space for years. Their strategy has been acquisition, acquisition, acquisition. And yeah, their fundamentals are really juicy, similar fashion with Adobe. But at the end of the day, like you need to kind of grow organically and go that route rather than acquisition because these LLMs will be replacing a lot of premier products that are super expensive that you have to be able to prove the ability to have the R&D and organically grow new products. If you haven't proved that in the past, you might be screwed in 5 to 10 years. Who knows? Like this is an insane environment to be in because this tech revolution we're seeing in the AI is something we haven't seen in almost 20 years. So nobody, like no analyst on the street knows exactly what the potential is. And they have no idea how to factor disruptors or how are they going to leverage this AI because it's such an early innings, it's happening so quickly that if you don't meet the requirements of these earnings, doesn't matter how much you're producing cash, you're going to get penalized. Having said that, if you want a quick bounce, I do see Adobe in the 440s, 450s having a bounce. And that's like not the worst place to do some kind of DCA. Having said that though, like do you want to be sticking your money in Adobe where they're worth over $200 billion? They're kind of a mega cap already. They haven't shown any signs of growth in the past couple of years or like what their long-term vision is. They've been pretty stagnant. There's other places to put your money in where you're clearly seeing AI being an absolute bump for them, like Microsoft, Nvidia, semiconductors, AMD. Like you're seeing the chip industry exploding and they're direct beneficiaries of AI, and you have no idea what the potential ceiling is there. With Adobe, you know exactly what you're going to get. So it's probably safer to be on the sidelines to see a couple quarters to see how management's going to start pivoting towards some kind of growth avenue. Because right now we haven't seen it, and there feels like there's been on a beach, retired, taking in that 40% free cash flow margin and just doing nothing with it.
Well, any boomer-led business, man, that's kind of the reality here. I think that isn't talked about enough. That like you have to understand these people are nearing retirement, and if you think that they're truly care about this company's runway, they don't. Unless it's founder-led, then maybe. But for the most part, it's like they don't give a shit about the stockholder. They never have, except for the stockholder that is themselves, right? So a lot of these guys, like even look Jeff Bezos cashing out with Amazon, it's like it's a risk equation. And I think a lot of them are going to err on the side of caution and they're going to take those leaps and take those gains right here, right now, when they know it's on the table, rather than bet on the future generations innovating for them, which is their true long term reward. And I think to just kind of echo what Shai's saying here, if you look at the chart here, guys, just from a technical perspective, clearly buyers were looking for something, right? We had that unprecedented run up early 21, May, June. We bumped to 698. I mean, we're trading almost $700 a share. Market cap effectively doubled, right? But then what happened? Well, clearly the innovation wasn't enough to move the needle and sustain the move, right? And then once again, here we have it. You could see it in the chart. If you look at a chart, you should see human sentiment because that's really what it is. This is just numbers back and forth. But it more importantly shows you human sentiment that we're very optimistic. I don't believe in this at all. This is shit. And then we're going back. We're trading 350s, 360s. I think we might be undervalued. Let's see this next earnings. Let's see what kind of guidance we get. Let's see what kind of tech we get. Let's see what kind of innovation we get. And we trade up. and everybody's disappointed again. But here's the best part for those of you that like looking at the chart too. And yes, this looks like a dick and balls, I now realize. But basically, looking at this, optimism didn't drive price as far as it did back in 2021, which means optimism may be dwindling. And in looking at that, it's important to understand that if that optimism couldn't even carry price further now, and they kind of continued to disappoint, next time that optimism comes in, how strong is it really going to be? And if it is even still remotely strong to the upside, can it carry? Because remember, it's like stock market, economy, fundamental, they're all disjointed at this point. Like it's a free for all. The value in the company may be there, but if the market doesn't understand that and appreciate that and trade in that direction, you're not going to see the appreciation in your portfolio that you want to see, I think.
No, I mean, you absolutely nailed it. I'm going to drop some knowledge right now for the audience. Like, market's been running high. Like, if you look at the weekly charts for the S&P and QQQ, clearly they're overbought. And I respect a lot the RSI, where it's like, if it's above 70, like, I'm not going to participate as much. Like, it needs to cool off towards their mean. It's just in 50. Right now, it's been over 70 for weeks. And semiconductors specifically, the SMH has been like 78, 80. SMCI has been like over 95. Like, that's absurd. I've never seen a stock hit that number and just maintain it. So any kind of company showing weakness, they're getting severely punished this earnings season, mainly because, especially this week, where we saw both PPI and CPI have been running hot, and it's not just this time; it's been consistently over the recent reports, and signaling real acceleration, inflation 3-month rate of change. Like, this is a big, big deal. Like, market's not really, it's shrugging off a bit, but we're slowly seeing some cracks where, like, oh, we should take some weight into like what's happening in the macro scale. And with Powell speaking next week, like, there's a 0% chance there's gonna be any kind of dovish talk. It's gonna be hawkish. This has not been what he's been wanting to see. There's been way too much cheery narratives that's out there right now, where clearly the economy is showing signs of strain. So Powell's upcoming statement is not gonna be good, and it's gonna throw a spotlight on the economic cycle and what the Fed's next moves will be. And biggest dark horse is any kind of hint of a rate hike might be on the table down the line. It doesn't have to be realistic. If he just drops a hint of, holy shit, like Q4, Q3, if things don't
A
improve,
touch of suspicion.
just a touch, there might be a rate hike. There's gonna be a massive sell-off. By massive sell-off, I mean S&P is going to go clear. What is it? It's going to clear 490. It's going to go approach 490, which is a key technical for them. QQQ is going to go below 400. Like, it's going to be, because all this movement in the market, it hasn't really been on earnings growth at all. It's just been multiple expansion, and that specific cause of a rally is the easiest to deflate and return back to the mean. So if Powell does like have any kind of hint of noise of like, oh, we factored this as a 0% chance, and now we have to bring it back to the table, investors won't like that. And especially with like energies rising up, and you're clearly seeing some kind of rotation happening in the industrials and energy away from tech in the past week. Like, I don't want to say it's a rotation, but it's something clearly happening where semis are showing weakness now. If you look at today's market, the leaders, Meta, Microsoft, not the semis as much, but like, still, I
Well,
would even say
Nvidia by
semis.
and large, like
Yeah,
period. Just
huge.
Nvidia. Too
And just
much.
Nvidia, everyone else, like all the previous winners, they're showing weakness today, and that's like precursor of a market mechanic top in the near term. So you combine that with Powell next week, like, we might be in for a shit show, and nobody, like, including myself or economists, like, can explain how the economy, inflation, I mean, how economy has been so like resilient. It's absolutely puzzling to me. And because of like not being able to figure out why that is, like, I think it's just because people are working multiple jobs and putting shit on their credit card, which is obviously a recipe for disaster. Like, things
Well,
are not
yeah.
looking good in the near term at all.
No, and you saw the fears around consumer debt, and like, I mean, you got big banks writing off record levels of consumer debt. Like, that's number one. Number two, I think agree that 100% the higher income earners are earning more because they're taking up more of the jobs because we've been inefficient for 50 years. And tech has also allowed us to just be maximally more efficient. Like we talked about this last week, you guys, like, isn't it Moore's law, I believe, whatever, that talks about the compounding growth of technology. And like what it does is it constricts cycles in terms of time. and it shrinks them, right? Like the amount of time we've developed more in 10 years than we did the previous 50, right? Period, as a civilization. Those macros apply micro. So in each individual stock and each individual company and us as people, we consume information at a rate that was unprecedented forever, right? And it's overload to a degree. But you look at the stock market cycles that you used to see, like all these old balls guys that are predicting, well, 12-year cycle and blah, blah. Like, I don't think that's a reality anymore because you're post pandemic, you're post multi front war, you're post Gaza again, you're post all these things, not to mention political unrest across numerous countries that are key players in like the geoeconomic politics of the world. You have, I think, most notably, something that few people start talking about maybe a couple of years ago, but not inflation, rather currency debasement, right? Cost of goods isn't going up. Your money just buys you significantly less, right? Because the underlying value of the asset and sentiment of the underlying value of the asset is just dwindling. So, in my opinion, take it for what it's worth. Your house is not worth more. Your money just buys you less. And I think that people are looking at prices and trying to determine value when that's not the case. If it was segments raising in value, like, hey, homes over 500,000, those raised by 30%, homes under 500,000, they went up by 6%. That's a value increase. But since we're talking across the board at scale, more weighted towards the bottom end, right? The lower cost homes actually have risen dramatic. Like, oh my God, so long story short, I lived in like a 3-bedroom ranch maybe 5-6 years ago, whatever. I lived there for a few years. It was my grandma's house. Basically, she passed away. I bought it from her estate, blah, blah, blah. House is worth maybe 185, nice, well-built brick house in good shape, but 185. I sold it during the beginning of COVID for like 230, right? And that initial bump of like, I got to get a house. So I capitalized and I sold it. And then I bought mid-range because basically at that point I realized like, okay, the lower level houses under 200K have appreciated much more than houses in the $400,000 to $600,000 range, right? Because you typically see more stability, more boomers in those price levels of houses. So we went right to that 500-600 range and bought a house there because that hadn't moved yet, and I knew it would. We moved there. I didn't like the house. It is what it is. My wife liked it. I didn't. Whatever. But dude, in less than a year, Shy, we made $100,000. We paid $475. We made $100,000 on that house. That's insane. That's insane, dude. That's insane. But again, you saw nearly a 40% bump in price on the lower level house. You saw nearly 25% bump in the mid-tier house. And then obviously you're going top to like 800,000 plus. Those didn't move as much. But now at this point, they've all moved, which tells you that it's not actually a specific segment of the market that's really moving or increasing in value or is in higher demand. It's that it's all bullshit because your money is just worth a lot less than it was. So again, look at the stock market, right? Dollars and cents, this is value. Is the S&P really worth more? Or does the dollar just buy less and it's following in kind with the value of money? As the value of money decreases, in theory, the price, even though the value has remained the same, the price would go up in the market. Does that make sense, or is that an insane conspiracy?
No, you're on track. I mean, it's alarming how on track you are because like I don't want to really digest that and make that a reality, but it it absolutely is true. And I'm trying to like I guess being naive. What's this phrase about naiveness is innocent? So there's some kind of phrase of ignorance is bliss. Exactly
Yeah.
like what I'm thinking about for that. But going on housing, like today's news was massive on Zillow. I don't know if you guys talked about Zillow
No, we did
today.
not. Go for it.
If you guys haven't noticed, all the housing stocks, Zillow, Redfin, EXPI, they've tanked today. And it's primarily because National Association of Realtors finally agreed to settle a series of lawsuits by
Oh, yeah.
essentially eliminating the rules of commissions. And this is a game changer for the industry. And not just the industry, from macro scale as well, because first off, Zillow is fucked. Absolutely fucked. They lost kind of their moats within that specific arena where they kind of made it fair for the competitors like Open Door, Redfin, where Zillow had a clear lead within that, but now it's like an even scale. But this also implements like if you're trying to sell a house now, you're obviously going to be taking your house off the market until this rule comes into light or becomes a reality because you're going to save thousands of dollars in commissions. And because of that,
Yep.
what does that mean in the near term? Supply is going to be way lower. Demand's not going to change. So there's going to be some wonkiness in the coming months on the macro data for real estate. And boy, add that little twist to what's happening in the macro data. Like it's going to be a tough Q2. And going off of that, like a slight pivot, because that's, I guess, unless Austin, is there anything else you want to add to that? But I thought it was like a very interesting news that got dropped today. And
No,
I
it
think Zillow
is.
has a lot
It
more
is, and
downturn.
I'm in the conspiracy zone now, so in my head, to be honest, it's like, dude, I wonder if they're worried about housing prices toppling, and this is just a way to continue to prop it up for a while. You get a 6%
100% could be
bump.
true. Yeah.
You get a 6% bump, and you lock up supply, which means, hey, demand goes up. That 6% bump turns to 12, and then it'll carry on. I don't know, man. I don't trust
No,
any of
you're
it.
I mean, this year is the year of conspiracy theories because anything you see, there is some backdoor action on an election year. So
Oh
maybe
yeah,
they don't want housing prices to tank during Q2, Q3 of this year ahead of election. We're like, Biden's going for re-election, obviously. So like,
yeah.
my house is
We'll put
worth
it
less
off for the
value, and
next
I'm
guy.
feeling the pain. Yeah, exactly.
Yeah,
So
let's let Trump deal with it.
um, so anyway, yeah, I guess no more conspiracies on that, theories on
Yeah,
that, but it is alarming what's happening then that scale, and macro data is going to see it. But anyway, I know I'm talking a lot of FUD right now and a lot of fear, but there's also some good things. There's some insane sales that's happening on the market due to short-term noise, and that's kind of my favorite areas to capitalize my investment. Where
where
nothing
you
about the
looking?
comp. I'm looking at Snowflake, ticker SNOW.
I'm with you.
This thing is an absolute monster, and everything that it's experiencing on this dip is a massive fire sale, in my opinion. Because one, if you look at their chart, yes, they've gone nowhere for so long, but they were the most expensive IPO in history, not based on market cap, but based on their valuation. Where I think they went public at over 100 times their next 12-month sales. That just shows the amount of demand it had at IPO. And it didn't matter what the near term value was because the long term is absolutely insane what their mode is. And this most recent quarter, there was nothing alarming about it. Clearly, business spending is better and it bottomed 2 quarters ago, but it's nowhere near pre-recession or tech recession. And I think a lot of investors got ahead of themselves, maybe me included, where we saw the optimization bottom out in Q3, Q2. Q3 was
Yep.
better, and we thought Q4 would be a big bump. Wasn't the case. And we're seeing with Costco's earnings, Dollar Tree earnings, all this like macro data, like shit's still bad out there. So the assumption of Snowflake like ramping up when they're using a consumption-based model, where what does that mean? Consumption-based model, they charge however much their client uses. So if their clients aren't really in a spot to reinvest into their business function, they're not going to do that right now because they don't have the luxury. They're handcuffed with the current environments. So Snowflake is kind of one of the volatile business models where it's not cyclical, but it is in a way at the dictation of what the environment is like. And Snowflake right now is just had a really kitchen sink quarter. And what's a kitchen sink quarter for Snowflake? I mentioned the Rule 40 score earlier in this call. Snowflake's kitchen sink quarter is still guiding at 25% revenue growth while maintaining 30% free cash flow margin. Combine those two scores, that's a 55 on the Rule of 40 metric. So when I say a kitchen sink quarter, they're still scoring a 55 on the Rule of 40 metric. That's like, are you fucking kidding me? It's like me getting grounded by my parents for getting a 95 in my essay, but they expected me to get 100. Are you kidding? It's an A. It's still an absolute A. And I think this is a huge opportunity because nothing about the quarter is thesis breaking. It's all around the macro. They got a new CEO, and that caught everyone off guard, me included. Frank Slootman, if you know about him, he is a goat in the industry. However, he's 65. He's worth over $1 billion. You can make the argument that they've had a very long. They haven't really innovated the past 2 years, where they create these new products like Snowpark, and really haven't really accelerated to go to market as quickly as they used to back then. And you could say he was coasting a bit, where he didn't have that innovation drive, which you absolutely need. And I've heard stories where that deteriorates when you get in the early 60s. That could be the case for here. But they got a new guy. This guy is absolutely smart. I listened to his interviews. Um, if you guys remember, and all the open AI noise with Sam Altman, like this new CEO, he was on the short list of 3 or 4 to take over the CEO as OpenAI. So that just shows the prominence of knowledge he has within the AI space. And Snowflake is a data warehouse. They own a third of the Fortune 500 companies. They own their data. So imagine what they could do with the AI applications, LLMs going forward, with someone like the new CEO in charge of that. So I think it's an absolute steal. Right, I've increased my shares 80% post earnings down, post earnings gap down, and it was already my second biggest position. So I'm absolutely bullish on them, and I think it's a huge opportunity. And I'm sure I saw the title of this call. It was Tesla, so I'm not gonna get into it. But I've been adding a shit ton of Tesla, and I made a tweet about
As
this
have I.
where the year is 2030. I'm drinking coffee with whatever the fuck the most common theme of milk is, and I look back at 2024 is like, fuck yeah, that was a year I loaded a bow ton of Tesla and Snowflake, and it's paying dividends right now. That's how I'm treating it. This year, accumulate your high conviction stocks. You're going to get opportunities. The macro will, I hate to say this, it will solve itself over time. Like you can't be a macro bear and dictate your investments, because clearly if you did that, you missed out on the rally the past 2 years when everything macro was awful, but the market's near all-time highs. There obviously is a disconnect between the two. So factor into the macro, but don't weigh too much on it. Stick to what you know. Invest in your high conviction stocks, and you're going to get some sales this year. And that's how I'm treating this year as.
I agree completely. Like on snow, we had this marked 144 and a half is going to be my load the boat. It's a major accumulation range. Any institution worth their salt will be loading there. I don't see a world in which they don't, if they aren't already. You are seeing record volume on this sell off post earnings. So I think that's really going to be the opportunity. I mean, they definitely hunt for liquidity, you guys. That's how they do this, because they're loading up positions bigger than an amount of money any of us can even conceive. So for me, it's the buy now, much like Tesla. I like a buy now, and I will buy down to 145, 140. Is I'll buy down, honestly, on this one. I'd buy down 132. I wouldn't go much lower than that, because then you're entering, that's a different story here. Because I think depending on how the macros of the markets play out and what we see, something Shy said to me, like, when we first started talking maybe a year ago or whatever, 6 months, whatever, was talking about 2024 being the stock pickers year. And I couldn't agree more with that sentiment, because it's going to be. There's going to be a few names that are on fire sale that give you maximum opportunity to capitalize on the next couple of years, which will likely be rough. If you're a macro ETF guy, this is going to be a tough couple of years for you, unless you're smart enough to go heavy on the what are they called, the inverses and all that other nonsense. So I think, but on the same token, it's like we've already shown that a company like Nvidia can drag the whole index up. So I think even in that case, you're trading flat, because you're just not going to get the weight you need to make a move either way. So look at it like when you're trading options and you get stuck range bound, you're burnt. If you're long or short, you're just done, because that theta is going to kill you. And I think the same is going to be true for that, except the theta in this upcoming market is going to be a couple carrying the weight of the many. And then on the same token, the pull down, drawdown of the many will cap what ETFs can see on the upside for the few that are booming. And so if you look at companies like Snow, Tesla, the buy opportunity starts now. Tesla, we broke this down earlier for like 40 minutes. The buy down opportunity is there to 140, and I'm going to keep adding. I increased my position on Tesla by about 10-15%. I bought about 35 shares at 161.90, and I will, in theory, I want to have 100 shares in that one account, so I could obviously sell covered calls against it. But I think that right now is the opportunity to buy that fear. I mean, look at what the big man does, Mr. Buffet. He's buying that fear, man. I mean, it's true. If you see the future, if you have the vision and the stomach to really take a look at what you think is going to matter. And then second question, who is best positioned to capitalize? Because like, here's what we know matters. Data, number one, king. As data is the new oil, right? So we know that's it, right? And then secondly, you look at not fundamentals. No, you look at software application. I think in my head, it's tech stack, software development, whatever. Anyone that has the application functionality capacity to really leverage both the internals of their business, so they leverage the data for their own internals, but then can turn around and sell it out the back end to everybody else, their market cap, of course, is going to eclipse everyone by and large. And again, with Tesla, the real value for me isn't the car, it's what drives the car. And it's hopefully seeing big automakers like Ford adopt their tech into their vehicles. And now Tesla has a white label licensing model on top of a quality brand. They might lose a little bit in sales, but I think they make it up tenfold in the data and aggregation, because then Google becomes a customer, everyone becomes a customer because everyone wants data. So we are in I don't know, it's almost like an oligarchy, right? With data, I think the monopolization of the market is terrifying, and that like Google, Meta, all the big ones, they're just going to keep growing. It is unlikely that many will penetrate the moat that they have. But the question right now is, how much meat is left on the bone for you, for me, the average investor, over the next 5 to 10 years? I'm assuming most people here are between 25 and 35 or so. Our focus needs to be the next 10, not the next 2, not the next 3, the next 10. Because once you hit 45, 50, you want to start being in a better position to obviously have security of retirement. Like, this is our opportunity to take the risk and bring home bags of money, as Shai said, sipping some sort of weird, whatever trending milk there is available at the time.
No, I mean, I couldn't agree with you more. I mean, I made a tweet today. It's like Tesla is being valued more like a car company each day, which I believe is a massive opportunity, because that is not going to be the same company in 5 years. Like, we're talking about generational wealth. These kind of entries is what provides generational wealth. Where what Austin was saying, like, this isn't really a car story or an EV story anymore. Tesla isn't software stock, in my opinion, because their FSD technology is going to be the new norm for the whole EV space. So it's inevitable by almost every car will be an EV. Guess what kind of software they're going to be using? Tesla's FSD. And how much does Tesla's FSD cost? $200 a month. Where is that $200 going to go? It's going to straight to the bottom line. It's a high margin business and vertical integration for Tesla. So yeah, they could give a fuck about losing a couple dollars per EV, because Elon, as he's the absolute guru and genius, like, he sees a long term vision. Like, I'll lose a little dollars over here because I know how juicy those margins are going to be for the FSD technology, and nobody knows when that's going to come. But again, all this noise and uncertainty, that's the time where you get in and buy, because this market is meant for retail to be losers. Like, it's not designed for retail to have a fair chance. It's all for the institutional buyers to have an edge, and everyone, the top 1%, to have that edge, designing to capitalize on the retail losing their money. So this FUD that you're seeing all over Tesla on CNBC, on the media, like, it's designed exactly how the game is supposed to be made, where retail's going to sell out at 160s when they bought in 250, 300. And guess what's going to happen? It's dumbbell mentality, where it's going to go the other way. And now everyone who sold at 160 is going to be chasing at 250, 300. But that delta they missed out on. And now it's just going to be a constant flywheel, and they don't be sucked in. And to go off of what Austin said about the software or data is the new oil, it's absolutely true. Where they're gonna have such unparalleled pricing power, like, where enterprises are gonna have so much data due to AI in the next couple of years that they have no idea what to do with it, but they know they have to do something with it. So imagine them trying to cut costs a little as a CTO because this enterprise software is too expensive. No, they're not going to do that because they know it's absolutely vital for the progress of their like the corporate strategy for their company. It's like, my car's going to be worth, if I went to go car shopping and they offer me a deal like, you can buy this for 30% less, but you have to drive with one eye. I'm not going to do that. I'm not going to cut costs to diminish my visibility of where I'm going just to cut costs for 30%. That's the same way enterprises are going to view software. Like, charge me what you want. Like, we have to do it. and we have to get it because this data is getting out of control, and we can actually create insights off this data based on your software. So like, whatever, charge $1 million. Like we have to do it. That's what's inevitably going to go down, and that's pricing power you're seeing on Nvidia right now on those juicy margins. They were way ahead of the GPUs, like way before anyone. So they had a first mover advantage, and now everyone's just
Mm-hmm.
like, please, please, Nvidia, give me your GPUs, please, because they were caught off guard. Nvidia wasn't. That's the kind of pricing power enterprise software the best of breed names will have in the next decade. It's not there yet. I'm front loading it right now. I don't know when the second wave will be, but I know it's going to happen, and I could care less if I'm early. I just want to be the first one there. So absolutely be cautious of where you're putting money in. Don't try to catch and falling knife. Like the cheap can always get cheaper. PayPal can always get cheaper. Enphase Energy can always get cheaper. Disney can always get cheaper. Like the list goes on. Like there's a reason they're so cheap. Where these like high premium, best of breed names have always had a premium valuation. It's well deserved because the future is kind of going to be wild for them. Where they're gonna have a lot of leverage and a lot. The half glass empty view of it is a lot of companies will be replaced too. It'll be down to zero. So you have to be very cautious on who to invest in. And that's why I said this year is the stock picker year. Honestly, the next couple years, because there's gonna be a lot of outflow in companies like going private or filing for bankruptcy. And there's gonna be a huge discrepancy of the distance between those companies who are like low quality software and the best of breed. Like there's gonna be a mass difference on what their futures will be like.
No, 100%. So I put it at the bottom. If you want to follow Shy, definitely do that. Stocks Heavy Shy on Twitter. I put it at the bottom. If you liked what we were talking about today, we got something big coming for you all very soon, using a very proprietary model that will set you up for the future. So make sure you're following his account so you know when it gets dropped. Final thoughts. We like Snow. We like Tesla. Final thoughts.
Final thoughts. Next week is setting up to be very bearish. Don't get scared out. Reevaluate your holdings to go towards your higher conviction names. Like today, I had made a very tough decision this week where I got into Celsius, ticker CELH. My average cost basis is in the low 20s. I haven't sold in years. I sold this week. Not the whole position,
Mm.
25%. Not because I'm bearish on the company and its outlook next couple of years, because I think their international expansion story is just beginning. It's just they're being priced similar valuation as a software name. And if you know the difference between consumer goods and software, it's a massive difference on how to factor into their modeling for the next 5 to 7 years. Like once demand like goes back to low teens, like it's gonna get re-rated and revalued. And I don't know when that's gonna happen. Like I don't know when the music's gonna stop for that. But when Snowflake's at under 160, Tesla was also at 160. Like, are you fucking kidding me? Like, I'm not. I'm gonna be trimming some Celsius to add to those monster names because, I think Tesla will be fighting for Microsoft for the most valuable company by 2030. So there's a ton of runway on what their potential could be. And B, Snowflake will be a mega cap, and right now it's under 50 billion. So knowing that, and Celsius is at 22 billion, I don't think Celsius can be $100 billion company. Like Monster, I don't think ever got into that range. Like I think Celsius, like the insane growth, insane margins. Spoke to John, their CEO, multiple times, and I think their story's not in the early innings, but there's a ton of runway. But I don't know what the long term like valuation will be like. I could see 50 billion, but again, at this rate, that's a double. But when I talk about Tesla and Snowflake, I see 5x potential. So that's a massive no brainer. So you reorganize. Like if there's some certain stocks that are like running this year, high valuation, don't really fall under like what you're absolutely bullish in which thematics next decade. Reorganize. Don't have a stubborn head during this market because this market will be very tough. It's gonna be ebbs and flows, ups and downs, and you really have to have an open mind of like what the market's giving you an opportunity for. Where Celsius is up 70% for the year, Tesla's down 34%, Snowflake's down 21%. I have to be flexible, and
Yep.
you have to make those moves quickly.
Yep. And that's the deal, man. You got honestly Celsius overvalued now. Look at this chart. Like, what's your runway? And I think that's the question not enough people ask is like, okay, cool, it's running and it's hot, but what can I buy now that everyone's gonna chase later? because you getting that entry is where
Yep.
you truly see those compounding returns. So, all right, I'm glad you jumped on. Thanks so much. I put his down there. Make sure you follow him on Twitter. There's a big release coming. You know his model. You know it works. You liked what we talked about. You're gonna fucking love what we got for you. So make sure you follow so that you can get it right when it comes out. It will be limited. Love y'all.
Awesome. Appreciate it,
Stay
everyone.
blessed,
Thanks,
man.
Austin, for having me. Talk to you guys
Of
later.
course. Bye bye.